Hi and everyone. Welcome to my YouTube channel, which is Explore Yourselves, Banking and General Knowledge, etc. Today I am going to describe about why waiting before filing income tax return can be beneficial. Introduction. Every financial year, taxpayers become eager to file their income tax return as early as possible. Early filing is often considered a good financial habit because it helps avoid last-minute pressure and ensures faster processing of refunds. However, tax experts frequently advise that filing too early, especially before all financial records are updated, can sometimes create complications instead of convenience. One of the major concerns during the beginning of the tax filing season is incomplete or partially updated financial data in government tax systems such as Form 26AS and AIS or TIS. If taxpayers rush to file returns before these records are fully updated, mismatches may occur, increasing the possibility of notices, refund delays, or defective returns. Therefore, waiting until mid-June or until all records are properly reflected can help ensure a smoother and more accurate filing process. Understanding why timing matters in ITR filing. Income tax return filing is not merely a formality. It is a detailed declaration of the taxpayer's income, taxes paid, deductions claimed, investments made, and financial transactions during the year. The Income Tax Department cross-checks the return filed by taxpayers and with data submitted by banks, employers, financial institutions, mutual funds, and other reporting entities. If this information is not fully updated in the system at the time of filing, discrepancies may arise even when the taxpayer has done nothing wrong. Important reasons to wait before filing ITR. Number 1. Form 26A may not be fully updated. Form 26A is one of the most important tax documents for taxpayers. It contains details such as tax deducted at source (TDS), tax collected at source (TCS), advance tax payments, refund details, and high value transactions. Sometimes banks, employers, or institutions upload TDS details late. If taxpayers file their returns before this information appears in Form 26A, the Income Tax Department may not immediately recognize the tax already deducted. This can lead to reduced refunds, additional tax demand, need for rectification later. Example, suppose a bank deducts TDS on fixed deposit interest in March but uploads the details only in June. If the taxpayer files the return in May, the deducted tax may not appear in the system, creating a mismatch. Number 2. AIS and TIS may not reflect all transactions. The Annual Information Statement (AIS) and Taxpayer Information Summary (TIS) contain detailed financial transaction records. These include bank interest, share market transactions, mutual fund investments, property transactions, foreign remittances, and high value purchases. Financial institutions take time to upload these records. Early filing may result in incomplete disclosure matching. Possible problems: income mismatch notices, reassessment queries, additional verification requests. Waiting allows taxpayers to review all reported transactions carefully before submission. Number 3. Bank interest and TDS entries may be updated late. Banks usually finalize interest calculations after the financial year ends. Many times, savings account interest, fixed deposit interest, recurring deposit interest, and TDS deductions are updated after some delay. Taxpayers who file too early may accidentally omit interest income or mismatch TDS credits. This becomes especially important for senior citizens and individuals with multiple bank accounts. Pre-filled data may contain errors or incomplete information. The income tax portal provides pre-filled information to simplify return filling. However, early in the season, this data may still be under processing. Possible issues include missing salary details, incomplete bank information, incorrect deduction reports, partial capital gains data. If taxpayers rely solely on incomplete pre-filled information, errors can enter the final return. Number 5. mix of notices and defective returns. One of the biggest concerns with early filing is the possibility of receiving notices from the income tax department. Common reasons include mismatch in TDS, missing income disclosure, incorrect deductions, transaction mismatch with AIS or TIS. Although many notices are routine and manageable, they can create unnecessary stress and additional compliance work. Waiting until all information is updated significantly reduces these risks. Important facts before filing ITR. It's recommended verifying the following carefully before submitting returns. TDS entries. Ensure all TDS deducted by employers, banks, or other institutions appears correctly in Form 26AS. Number 2. Bank FD and savings interest. Check whether savings account interest, fixed deposit interest, recurring deposit interest have been properly included. Even small amounts should not be ignored. Number 3. Mutual fund and share transactions. Investors should verify capital gains statements, dividend income, SIP transactions, redemption records. This is particularly important because market transactions are extensively tracked. High value transactions, SFT. Specified financial transactions may include large cash deposits, credit card payments, property purchases, investment transactions. Taxpayers should ensure these records are correctly reflected and explained. Number 5. Salary details with Form 16. Salaried employees should compare Form 16, salary slips, AIS details, refilled information before filing returns. Any mismatch should be corrected immediately. Why correct filing is more important than early filing. Filing early certainly has benefits, including faster refunds, better financial planning, reduced last minute pressure. However, accuracy remains more important than speed. A carefully prepared return helps avoid tax notices, reduce correction requests, prevent refund delays, and maintain compliance steady. An accurate return filed slightly later is often better than an incorrect return filed too early. Smart approach for taxpayers. Step 1. Collect all financial documents. Gather Form 16, bank statements, interest certificates, capital gain statements, investment report, loan certificates. Step 2. Verify Form 26As. Check whether all tax credits are visible. Step 3. Review AIS thoroughly. Compare all financial transactions with personal records. Step 4. Match pre-filled information. Do not rely blindly on pre-filled data. Cross-check every figure carefully. Step 5. File only after complete verifications. Once all entries are properly reflected and verified, proceed with filling confidently. Conclusion. Income tax return filing is an important financial responsibility that requires accuracy, patience, and careful verification. While early filing may appear beneficial, submitting returns before tax records and financial information are fully updated can create unnecessary complications. By waiting until all entries in Form 26A, AIS, TIS, bank interest records, salary details, and investment transactions are properly updated, taxpayers can reduce the risk of mismatches, notices, defective returns, and refund delays. The goal should not simply be filing early, but filing correctly and confidently. A well-verified return ensures smoother processing, peace of mind, and better long-term financial compliance. Disclaimer: this content is intended purely for general educational and informational purposes. Tax laws, filing procedures, and reporting timelines may change from time to time based on government regulations and income tax department guidelines. Taxpayers are advised to verify all information from official sources or consult a qualified tax professional, chartered accountant, or financial advisor before filing their income tax returns. Thank you very much for your patience. Request to like, subscribe, and share.